Well, if you're wondering why farmers are so concerned about their farm finances right now, they really just can't catch a break. It's not just because corn prices are below break even for most. It's the fact input prices are so high.
The U.S. has lost the corn crown. We've been the world's top exporter of corn for just about every single year in history.
China froze purchases of U.S. soybeans and corn ahead of the looming tariff showdown, a devastating blow. The USDA has now scrapped community food programs that supply Humboldt schools, tribal communities, seniors, and food banks while supporting American ranchers and farmers. Corn prices have crashed to $3.50 per bushel, sending shockwaves through the entire U.S. Corn Belt. More than 2 million tons of corn were redirected back to New Orleans by overseas buyers, turning million-dollar agreements into worthless stacks of paper in an instant. From Iowa to Indiana, combines sit parked because harvesting now only deepens financial losses. Cracked kernels rot in the open rain, forming vast, unwanted mounds. As U.S. farmers face fresh debts and shattered confidence, Canada has quietly claimed a multi-billion-dollar grain supply agreement with Japan, South Korea, and even Europe, a stealth takeover at the global dinner table. So why has American corn collapsed so rapidly in 2025? While Ottawa calmly signs deals that funnel millions into Canadian coffers, today's video will expose every fracture in the U.S. corn market and explain how Canada has risen to the top of the grain hierarchy. Subscribe to Innovation World and enable notifications so you never miss our latest economic and political breakdowns. Tariffs are devouring U.S. corn before it even leaves the dock. When the White House placed fees of up to $1.5 million per voyage on Chinese-built cargo ships, freight costs through the Gulf of Mexico surged by roughly 25%, adding $930 million annually to export expenses. Trans-Pacific container shipping rates offered no relief. Within the first 2 months of the year, Asia-bound freight spiked to nearly $5,000 per FEU, double the post-COVID baseline. But the second blow cut deeper: pesticide residue testing. On March 14, 2025, the Federal Grain Inspection Service issued Directive 9180.40, increasing the multi-residue export testing fee from $57 to $81 per sample, a jump of 40% in a single season. Every U.S. corn shipment now needs this green pass or risks being turned around mid-journey. Costs soared, yet the grain still didn't move. February's grain transportation report showed barge traffic on the Mississippi down 16% from the 5-year average, while New Orleans berths jammed up due to a shortage of empty containers and new security paperwork requirements. More than 180 ships sat waiting offshore, forcing Iowa and Indiana corn to spoil and blacken. Farmers lose another 27 cents per bushel simply waiting for a vessel. Meanwhile, global import rules have pivoted toward Clean Plus, Green Plus, blockchain verified. In February 2025, Mexico formalized a ban on GMO corn, giving preference to pure grain with low-carbon certification, a move quickly copied by Asian and European feed buyers. With 92% of U.S. corn acreage genetically modified, America was promptly erased from the white list. Canada, boasting its Prairie Trace blockchain system that tracks every shipment from field to port, swept in to capture billion-dollar contracts with Japan, South Korea, and the European Union. The result was immediate. Midwest spot corn dropped to $3.45 per bushel, the lowest since 2016, while Manitoba prices held at $4.20, thanks to the low-carbon premium. International traders didn't hesitate. U.S. cargo was costlier, testing took longer, and it failed the non-GMO requirement. Switching to Canadian supply was the obvious move. On the docks of New Orleans, the global corn map is being redrawn. One side shows torn-up U.S. contracts stacked high. The other sees Canada's flag on premium cargo fetching 20% more, just for carrying the green certification. With inspection and logistics costs still climbing, the question isn't when U.S. corn will recover. It's whether America's producers will even have a seat at the global table. Picture an entire county in Iowa drowning in unsold corn that nobody will buy. Reuters reports that unsold U.S. corn stocks have reached a 6-year high. The USDA estimates that by the end of September, over 2.5 billion bushels, roughly 68 million tons, will still be stuck in silos, baking under sun and rain. This week, the cash bid in Cedar Rapids sits at just $3.74 per bushel for September delivery, while average harvest costs in Iowa run $165.75 per acre. That painful gap is driving Midwest farmers to list John Deere 660 combines on Craigslist, or moonlight as Uber drivers just to keep afloat. Reuters notes that some households are holding on to 90% of their crop because selling now would only worsen their debt. In Indiana, the crisis isn't just financial. The state's Economic Council reports the Corn Belt economy shrank 6.1% in the first quarter of 2025, the second worst drop in the country. With incomes gone, food aid requests have surged. The Food Bank of Indiana says demand for assistance is up 50% year over year, even as proposed SNAP budget cuts threaten to erase 133 million meals. In Illinois, the domino effect continues as the Mississippi River waterway suffers record low levels for the third consecutive year. Barges must carry lighter loads and shorter tows, adding $20 per ton to reach Gulf ports and delaying shipments by up to 15 days. The bottleneck forces crops to pile up. Farmers face rising interest rates while land investment funds scoop up acreage at discounted prices. In April alone, the Midwest Farmland Index ticked up 6.5%, despite the cooling broader real estate market. Some rural school districts have shifted to 3-day in-person weeks to cut energy costs. Nebraska and Minnesota, often called America's underground corn vault, are now under irrigation restrictions. A new rule from the Little Blue NRD caps water use at 13 inches per acre per year, prompting co-ops to pause purchases to avoid overflowing storage. Along Highway 6, grain trucks have vanished, gas stations sit empty, and local diners shut their kitchens early due to lack of customers. The local paper has dubbed it a zombie economy, storefronts still standing but cash flow dead. Ethanol plants are also feeling the hit. The EIA reports Midwest ethanol production running at just 87.8%, with 25 plants closed, idling 1.26 billion gallons of capacity. In Columbus, Nebraska, Valero's plant has cut 60% of night shifts, leaving 120 workers without jobs. From overflowing silos in Iowa to stranded barges in Illinois to shuttered pumps in Nebraska, each broken link pushes the crisis deeper. U.S. corn, once the pride of the Midwest, is now dragging down the very communities that depended on it. While Canada's Maple Leaf quietly collects billion-dollar deals, the question in Washington is no longer when corn prices will recover, but how many towns will become ghost towns before they do. Canada isn't rescuing U.S. corn, it's methodically building its own premium market, one so reliable that foreign buyers compare it to purchasing a Swiss watch. Every Canadian shipment carries blockchain verification from seed to export terminal, virtually eliminating counterfeit risk. A Farmit report notes that blockchain traceability has become the norm for North American exporters, with Canada leading the charge thanks to tightly coordinated farmer co-ops in Ontario and Saskatchewan. But traceability alone isn't enough. Ottawa enforces the 3 no's: no GMO, no glyphosate, and no carbon emissions above the EU's RED II limits. Under the 2021 RED II rules, entire supply chains must prove their carbon footprint from planting to delivery. Canada is the first in North America to roll out a unified disclosure system for corn, enabling shipments to clear EU customs up to 20 days faster than U.S. grain. The payoff is clear. The June 2025 market trends report from Grain Farmers of Ontario shows old crop corn earning $1.30 to $1.87 per bushel above CBOT futures, a 22 to 30% premium. New crop corn is still fetching $1.49 more, about 18% over Chicago prices. That explains why Asian feed buyers are willing to pay more. They're buying a green reputation, not just grain. The biggest boost came in March 2025 when Canada and South Korea signed the CSKO-ESA organic equivalency deal. Within 3 weeks, Ontario co-ops had secured a 5-year supply agreement with a major Korean feed mill group. Meanwhile, Saskatchewan took advantage of a weak Canadian dollar and US-EU trade tensions to sell non-GMO corn to Japan and the Netherlands. According to USDA Ottawa, exporters are diversifying because of Washington's 25% SPA duty. As a result, fall 2025 EU contracts are averaging 18% over CBOT based on Rotterdam desk figures, a level Midwest farmers have never seen. Behind the scenes, Ottawa supports its farmers with tools like single-lot export credit insurance and reimbursement of up to 50% of cold chain logistics costs to preserve low-carbon certification. These benefits are advertised openly on Export Development Canada's website, giving companies the confidence to meet stricter standards and avoid rejection over residue tests. The ripple effect is visible in shipping. In the same week Canada signed the CSKOEA, the U.S. Department of Agriculture reported only 30 grain ships loading in the Gulf, down 14% from last year, with forward bookings off 17%. Reuters notes that U.S. importers are now routing shipments through Vancouver because Canada's rail network connects directly into the Midwest, taking advantage of cheaper backhaul rates on empty containers returning from Asia. Simply put, North America's grain compass has shifted. Capital, vessels, and contracts are all tilting toward Canada. From blockchain tags to double-digit premiums, Canada has mastered the new rules of the game. When global standards turn green, the first mover avoids returns and cashes billion-dollar checks. While Iowa farmers slash their losses, Toronto's trade clock keeps ticking, adding fresh orders even as Chicago's board stays in the red. American corn, once a global staple, now faces a red alert crisis. And the danger doesn't stop at grain. The shock is spreading to soy, beef, and dairy. If Washington doesn't act, soybeans, with 92% GMO acreage, will follow corn into exclusion lists like Europe's low-carbon registry. That will push feed prices higher, triggering the largest wave of small farm bankruptcies since the 1980s. Beef will fare even worse, as every pound raised on high-carbon corn faces heavier taxes compared to Canadian and Australian competitors who have pledged net zero by 2030. The White House now faces two choices. First, dismantle protectionist barriers, lower tariffs on green farming equipment, adopt blockchain traceability, and align carbon rules with trade partners. A politically costly move, but one that restores U.S. credibility and market access. Or second, maintain tariff walls, keep convoluted inspections, and rely on subsidies, the same playbook that drove the Rust Belt into decline 3 decades ago. If they choose the latter, Canada won't just take market share, it will seize the trusted, sustainable brand tied to billions of meals worldwide. The clock is running. Will Washington reset the course, or let rural America derail completely? Share your thoughts below, because this decision will shape not only the price of corn in your bowl, but the livelihood of millions of U.S. families. And this is just the opening round. If you value timely political and economic insights, subscribe to Innovation World and turn on notifications so you never miss an update.